Let's kick things off with a slew of economic data we got out to round out the week this morning. Consumer sentiment, inflation data, and spending all out today. And consumer spending, which makes up 2/3 of the U.S. economy, dipped 1% last month versus the 0.7% drop economists had been expecting. Personal incomes also tumbled 7.1% after surging a little over 10% in January off that last stimulus wave. But when you back up and look at sentiment, University of Michigan final reading for the month of March showed new strength, rising to 84.9 versus a preliminary reading of 83. That was the highest we've seen since the March 2020 level of 89.1. It also showed more consumers expected good rather than bad times in the national economy in the year ahead, 49% versus 41% surveyed. A major improvement from last month when negative views were held by a little over half of the respondents there. So let's bring in our first market guest to break it all down and where we're at in this recovery. Joining us is the Chief Investment Officer at Girard, Timothy Chubb, is on the show with us. And Timothy, appreciate you taking the time here to chat. When you look at that data, particularly the stronger than expected consumer data there, talk to me about where you think we're at in regards to maybe how strong the next few months are going to be as this reopening continues.
Sure, and thanks for having me. Yeah, I think, when you flash back to the fourth quarter last year, just a couple months ago, it feels like, a lifetime ago, our big concern was what vaccine distribution rollout would really look like. And I think, while there's certainly been some hiccups along the way, the data recently has showed, with the number of Americans receiving at least one shot, I think a pretty promising story for the economic recovery to continue later this year. And recently, we've seen bond yields start to stabilize a little bit. The sell-off has ended, at least for now. And I think this year could potentially be a Goldilocks scenario where we see inflation not nearly as high as what maybe investors are expecting. I think maybe some investors are confusing reflation with inflation and expecting that inflation will actually skyrocket, which I think is unlikely, especially as we get into 2022. And ultimately, growth continuing to be strong as the year continues and more Americans are able to get back to their normal lives and hopefully support the economy. And so, we're a bit more optimistic. Over the last couple of months, we've seen, there's been some pockets within the market where there's been some significant overvaluation. A lot of that has been correcting itself of late and ultimately presenting a pretty interesting buying opportunity if you're a long-term investor in some growth names.
On inflation, Timothy, we got that PCE number that seemed to at least assuage some concerns that have been in the market about inflation ticking much higher. What do you make of the reading, especially given your expectation that this is really just kind of a bump that we're going to see on the way back down later this year?
Yeah, right. There's two things that are driving this, as is always the case, supply and demand. And when you look at the labor market with unemployment rates probably a little closer to 10%, despite what the data shows, just with how the numbers are calculated with people leaving the labor market, we're not going to see wage pressure, I don't think, until probably the end of next year, which, again, is basically in line with where the Fed is thinking we'll start having some conversations potentially about raising rates in 2023. So I think on the demand side of things, we're obviously seeing the economy growth later this year start to reaccelerate. The economy to normalize. Demand has been increasing for a lot of different commodities, especially lumber prices have been going through the roof. But some of that is due to supply chain issues. And so we still have to remember that we're in this global pandemic, and there's going to be difficulties due to social distancing and getting certain things to American businesses or global businesses from the supply chain perspective. You've seen what's going on, the compound things in the Suez Canal this week. And so, I think some of that will be likely alleviated once supply is able to properly meet demand within the markets. But we still think demand will be strong as the economy normalizes. But I think if we saw inflation peak out around 2.5%, sometime this summer, that's probably the high end of things. Does that take the 10-year up closer to 2% potentially? But as we look further into 2022, I think we'll start to see inflation maybe creep back down around closer to that 2% number, which ultimately is not too far from where we've been for the better part of the last 10 years, where inflation has been incredibly difficult to generate.
Yeah, 1.6% in February versus a year earlier. Those year-over-year comparisons are going to get much more interesting as we move forward in this recovery. But still, When you look at the stripped out energy and food costs, 1.4% versus January's 1.5%. So, I mean, when you think about inflation, just putting that into context. But the other interesting update from the Fed, talking about bank buybacks, we saw them update the timeline there, not until June 30th, as long as banks can pass the stress test, they'll be allowed to resume buybacks there. How does that maybe signal some of the confidence? Because I've been looking at companies that have been hard hit that really paused some of those buybacks earlier in the pandemic, returning to it as a sign of strength. What do you make of that as maybe being a signal for the financial sector here, and how should be investors allocating now?
Yeah, great question. I think ultimately, flashback to the global financial crisis and the amount of reform that took place, particularly with the banking sector, ultimately is, gone through probably the most difficult test that we would probably ever experience. Hopefully, I say that, I guess 11, 12 years after the global financial crisis. But, what we went through this time last year was effectively could have been another financial crisis. I mean, as you said, opening up the show, the U.S. consumer is 2/3 of GDP. And when the U.S. consumer was sitting in their homes, they weren't consuming, and therefore GDP declined significantly, during 2 quarters last year. And so, I think what it comes back to, as far as the GDP is concerned, we'll likely see the acceleration take place later this year as things normalize. But the consumer, I think, is in relatively decent shape. We'll see personal incomes jump once again as we get the data with the next round of stimulus. But overall, we're feeling a little bit more optimistic. I think inflation's in check, and like I said, it's a bit more of a Goldilocks scenario.
And Tim, we're seeing financials up almost 1% sector-wide today. To Zach's point there, now that we have a bit of more clarity on timeline for banks to accelerate dividends and buybacks, do you add to your position there?
No, we're actually taking money off the table right now. And so, again, the banks have performed, I think, extremely well through all this. From a stress test scenario, I think it's a positive that, the Fed is considering with how conservative they've been to allow them to start increasing dividends and buybacks once again. And so that's a huge positive. We also want to be cognizant of capital allocation across the entire industry. I think a lot of banks are realizing that this low rate environment is likely here to stay. And so non-interest income is going to be extremely important to grow moving forward. And I wouldn't be surprised if maybe they rethink the amount of dividends and buybacks that are going to be taking place and ultimately allocate some of that capital back into their business to reinvest. And so, banks have priced in a lot of the positive news that we'll expect later this year. Obviously the yield curve steepening has been a huge benefit to them. I just think that we're getting closer to the end of, sort of this move for a lot of the bank stocks and reopening names in particular. And so, as we rebalance as a firm this quarter, we're taking profits in banks, we're taking profits in leisure, we're taking profits in travel, which has been running extremely hard since November. And while we still think there's some room to run and we're going to stay convicted with our names, I think a lot of the growth companies are presenting an interesting opportunity as value and banks have obviously surged within the last 3 or 4 months.
All right, Girard CIO, Timothy Chubb, appreciate you coming on here to chat all that with us. Have a great weekend.